Welcome to Vinac Resources, presenting to you ratio analysis, specifically the liquidity ratios, which includes current ratios, quick ratios, cash ratios, and working capital. Again, welcome to Vinac Resources. Liquidity ratios. These are measures to show the strength or preparedness of a company to pay for its short-term obligations. The common liquidity ratios that we have include the current ratio, quick ratio, cash ratio, and the working capital. Let us start with the current ratios. This measures if the current assets are enough to pay for the current liabilities if have to be paid immediately. This is calculated by the formula current assets divided by current liabilities. Usually, if the current ratio is more than 1, it's considered to be good. This means that a company has enough assets to cover for its immediate short-term liabilities. Let us show how we can be able to calculate the current ratio. Usually it's calculated from the balance sheet information. We have the debit side and we have the credit side of the balance sheet, and this balance sheet is for Everest Incorporated. As we saw, the formula for calculating the current ratio is current assets divided by current liabilities. Here we have the current assets over there in the debit side, current liabilities in the credit side, and we divide them, we get our current ratio as 4.07. As we note, it's more than 1. It means the company has enough assets to cover for its immediate liabilities. Quick ratios. These are measures that show if the quick assets, specifically the cash and its equivalents, are enough to pay for the current liabilities if they come due. Now, the cash equivalents are marketable securities which can be turned into cash immediately, like the savings and money in the stock, and also the accounts receivable. Now, inventory and prepaid expenses are not considered cash equivalents, so they are excluded from the quick ratio. Now, the formula for calculating the quick ratio is cash plus marketable securities plus accounts receivables divided by the current liabilities. Now, the quick ratio of more than 1 is always or in often considered to be good. And this actually means that a company has enough of the liquid assets that can be able to cover for its immediate short-term obligations if they come due immediately. Now let us see how we can calculate the quick ratio, and we are going to use the same balance sheet for Everest Incorporated. We have the debit side and the credit side, as you can see over there. And as we saw, the quick ratio is using the formula cash plus marketable securities plus the accounts receivables. Then we divide that by current liabilities. Now our cash marketable securities are over there. Then we have the accounts receivable there. Then our current liabilities is over there in the red. And when we divide those by that, we get 1.77. As you can see, it's more than 1. It means that Everest Incorporated has enough liquid assets to cover for its immediate or short-term liabilities. Let us move to the third liquidity ratio, which is a cash ratio. It measures if the current cash assets are enough to pay for the current liabilities. And the cash assets in this case, it excludes inventory and receivables. And the formula for calculating that is cash plus only the cash equivalents. Then you divide that by the current liabilities. If the cash ratio is more than 1, it's considered good, meaning the company has enough cash to cover for its immediate obligations. Time to calculate the cash ratio. We are going to use the same balance sheet for Everest Incorporated. We have the debit and the credit side over there. And as we said, the cash ratio is calculated by using the cash plus only its equivalents divided by current liabilities. In our example, it's marketable security and cash, which are the cash equivalents, divided by the current liabilities. You can see over there, 255K divided by 175K, we have the cash ratio of 1.45. It's more than 1, meaning the company has enough cash to cover for its immediate or short-term liabilities. Let us move to working capital. This is a measure to show how much money a company has got left after paying for all its short-term obligations. As you can hear from that term, it means the, its working capital is equal to current assets minus the current liabilities, and the leftover is the working capital. If the working capital is positive, it's considered to be good, and if it's negative, it's considered to be bad. In this case, when it means that the company has got enough assets to cover for its short-term liabilities. Let us see how we can calculate the working capital. We're going to use the same Everest Incorporated balance sheet. We have the debit side over on the other side, and we have the credit side over there in the right side. The formula, as we said, for working capital is current assets minus current liabilities. In our case here, we have total current assets as 716K and our current liabilities as 175K. Putting those in our formula, we get a working capital of 540,350. This is the amount that is left after the company has paid all its current liabilities. As you can see, the ratio is positive, meaning the company has enough assets to cover for its short-term obligations or liabilities. We have come to the end. If you have any questions or comments, please reach out to us at Finac Resources. Also subscribe at Finac Resources, and we will be glad to give you more and more resources which are in finance and accounting sectors. Thank you.